James, you mentioned in an earlier video that you are a fund of funds guy now after getting out of that horrible day trading game. There have been a lot of funds that have done poorly. Do you pull out when they've done poorly?
You know, that's a great question, actually. Historically, over the past, let's say, 3 years, I've had funds that have had dips, and those are always the exact times you want to go into them. Depending on the dip. You always have to visit the manager. You have to find out exactly what the book is, why they had their dip, what's going on. But those are just like stocks. I like to buy dips. Hedge funds, I like to buy dips as well.
Do you think that So Wood Capital would still be in business if the fund of funds had not looked at them down 10% and panicked?
Yes, I think they'd still be out of business. And you know why?
They'd still be out of business.
And there's a lot of evidence that suggests they basically broke down completely on risk management. I mean, just behind the scenes.
And that really does happen, right? There's just guys who just crap out.
Their risk manager actually quit 3 or 4 months right before the end. Yeah, I mean, it was
really?
The wheels were falling off. And there's a lot of issues there. But their book, they were saying their book was 20% marked down.
Right.
It's probably more like already 50% down.
Because the marks were big. Yeah. The marks were bogus.
What's really interesting right now is the big funds of funds, the real superstar funds of funds, those are the ones doing the worst. Because they were in D. Shaw, they were in AQR,
right.
they
all
were
the
in
boxes, because the boxes always generated consistent returns, or they were doing the thing that Chiaffi was doing at Bear Stearns, which they were buying mortgages with short-term repo paper.
Yeah, and then they had to lever up 12 to 1 to get the 1% a month. It was ridiculous.
Right.
But here's the question I have for you. Does this mean now a return to just stock picking? Hedge funds don't stock pick anymore.
No, because the institutions in general are just so fall so easily prey to the talk. I mean, I remember going into a major institution, I will not mention the name, and everyone else had these big quant presentations, and I thought that they were all completely BS. So I go in and they say, "What's your style?" I said, "My style is to make money any way I can as long as it's legal, and I have 100% of my assets in it." And they just said, "Get out."
Yeah.
They just said, "Get out." And I was like really truthful. And then as soon as I let that, I said, you know what, I should have just lied and just put the chart up and say, here's where I am in the quadrant. But there was something about just the fundamental dishonesty of it that kept me from doing that.
It's true, and they're going to get fooled again and again. They were fooled with mutual fund timing. That was the first sort of holy grail trade. Then this subprime, mortgage arb trade. Then the put selling. What's next, though?
Well, what's put selling?
So put selling is, let's say the S&P 500's at 1450. Right. You're selling puts all day long, a couple hundred points underneath that. And you just collect the income every month.
But what happens in a big decline?
Well, you go out of business. And there's at least one hedge fund that I know personally completely wiped out. Many hedge funds are like 40 to 60%
They're teetering,
down
right?
This month.
Oh, boy.
They're in trouble.
Well, let me tell you a quick story before we break. When I left Goldman, I went to, I looked for an office space, and I found this place, and I can't even remember the name, but it was right around here. And the guy said, listen, you can come in, I got an empty desk, it's fine. I said, what do you do for a living? He goes, I sell puts. Okay, this was probably 4 months before the crash. And, he said, listen, come back in a couple of months, I'll have an office all ready for you.
The whole floor was empty.
Yeah, well, when the crash occurred, and he closed his doors literally the terrible Tuesday, the day before Black Monday, the day after Black Monday, because you just lost too much money. And as a matter of fact, of course, you have big capital call on the partners.
Well, here, volatility spiked, 23% last Thursday when the Dow declined 400 points. Like, historically, 9 out of 10 times the Dow, the market's up 6 months later at an average of 10%, but the put sellers are zeroed.
Now, you mentioned that some hedge funds are down 40, 50%. We're going to read about these soon, aren't we?
Oh, yeah, you're going to read about them, and you're going to read
When are you going to read about the end of August?
You're going to read about them when the fund of funds go out of business who own them.
Now, but these are all going to be negative things that are going to be in the paper and scare people.
I don't know, because it'll be like anything. We were already scared last week, and we'll survive.
So it's possible that when you see that news, it will be known by a lot of people, and it might be a buying opportunity, not a selling opportunity.
Think about last week. Like, people were not scared because hedge funds. People were scared because they think housing's going to zero.
Right.
So, but it turns out to be a hedge fund problem. We hope, we think.
Right.
And so the next time there's a hedge fund problem, people will realize, oh yeah, it's just those hedge funds again.
Well, a lot of people. Well, let's do this. Let's have one more video about, I'm just talking, because we're work in progress. Guys, have a video. I will give you the post-Bernanke scenario. Okay. And you give me post-Bernanke scenario.
All right, let's do it.
Okay?